Insurance contracts have a lot of clauses. I'm sure you may have seen an insurance policy similar to other contracts. There are lots of clauses in there. In this segment, let's look at some of those important clauses. Not that all the clauses are not important, but these are some of the ones we want to highlight to make sure you have a clear understanding. And this is also important, obviously, for the policy owner to make sure they understand these critical clauses. So first thing we want to talk about is the fact that there are some exclusions on an insurance policy. In other words, some situations where the death benefit is not going to be paid. And common exclusions are really the suicide clause, which we'll spend a few minutes on, the incontestability clause, and there may also be some situations where if someone is maybe they have some sort of dangerous hobby, skydiving or race car driving, some insurance policies will exclude coverage if you die as a result of performing those activities. But the basic general exclusions we want to talk about here are the suicide clause, which, if the life insured commits suicide within the first 2 years of the policy, then there is no death benefit paid. So there's a 2-year suicide exclusion. If the life insured commits suicide within that 2-year period, usually what happens is the insurance company will return the premiums and the policy death benefit, as I said, would not be paid. So that's your suicide exclusion clause. We also have the incontestability clause. Now, the incontestability clause basically has a 2-year contestability period. And so in that first 2 years of a contract, of a policy, the insurer can contest the policy if they discover that there's been a material mistake in the application. In other words, they discover something that if they had discovered it before, then they might not have issued this policy in the manner in which it was issued. It might have been issued potentially differently, or it may not have been issued at all. And so they have 2 years to discover any of these material mistakes. And again, a material mistake is something that, as I said, it's material to them accepting that risk. If it's something very simple, they may, even though they may have discovered it, that may not necessarily change the policy. They may not do anything. But if they feel that information is material, it would have changed their decision in the underwriting process, then they have the right to contest the policy. And it might be that they will make an adjustment and allow the policyholder to continue the policy, or they may just decide, no, they're going to cancel the policy. Now, these are for inadvertent mistakes. I guess honest mistakes, if I can use that. But again, they have to be material to the insurance company. The other situation where you're going to have the policy contested is that if, in fact, the policy owner in the application process had committed fraud. In other words, they did not answer all of the questions honestly, or they withheld information, they tried to conceal information, and they have demonstrated an intent to deceive the insurance company. So intent to deceive is the definition of fraud. So if the insurance company, let's say maybe at time of claim, in their claims investigation, find out that there's something fraudulent in terms of the information that was submitted by the policy owner, or there's fraud involved in the claim, then that policy will not be paying a death benefit. So remember, material mistake has a 2-year limit, but for fraud, they can contest the policy at any time. So that's the incontestability, 2-year incontestability clause. The next important clause that is in an insurance policy is something referred to as a grace period. So the grace period simply says that if your premium is due and you have not paid it, you missed the premium due date, you basically have 30 days to pay the premium, and during that 30 days, the insurance company is going to keep your policy in force. So your policy will not lapse. And if you do not pay your premiums within that 30-day period, then the end of the grace period, this is what the 30-day period is referred to, at the end of the grace period, if you had a term insurance policy, then in fact your policy will lapse because there are no values, there's no cash values in a term insurance policy to allow us to continue that policy going. So after 30 days, if no premium is paid on a term policy, that term insurance policy will lapse. For permanent insurance policies, after the end of the grace period, the policy will go on APL, automatic premium loan. So if obviously there is cash value in this permanent policy, then the automatic next step is an automatic premium loan wherein the insurance company will start borrowing from that cash value to pay the premium. So that's important, I guess, another benefit of having a permanent policy, and that is if you haven't paid your premium at the end of the grace period, the automatic premium loan feature will come into place. And eventually, if you still don't pay your premium and you eventually run out of cash value, then the policy will lapse. So this is how the grace period works. Again, a little different for term insurance and permanent insurance with cash value. Now, obviously, if you have a permanent insurance policy with no cash value in it, then it'll kind of operate just like a term plan. In fact, it's going to lapse at the end of the grace period. So this is what is referred to as the grace period. Let's move on. Reinstatement clause. So a reinstatement clause says after your policy has lapsed, which is what we talked about before, so after the grace period or after the end of the APL, there's no more cash value, your policy is no longer in force, it has lapsed because you have not paid the premium, you actually can start that policy up again within 2 years of the lapse. So the policy is lapsed, you have another 2 years to reinstate that policy. And so what do you have to do to reinstate the policy? Well, you have to provide evidence of insurability. So you give them medical, again, evidence of insurability. You have to pay the back premiums, the premiums that you owed since the policy lapsed, plus interest. Now, so you have to pay back premiums plus interest, provide proof of insurability, and if all goes well and you're still insurable, then they're going to restart the lapsed policy. The big advantage of this is that when they restart the lapsed policy, you are going to keep your original issue age for the premium. So, for example, if you had the policy and it's 10 or 15 years old and it lapsed for whatever reason and you decide to reinstate it, you're going to be able to reinstate that policy and pay the premium, the same premium you paid 10 or 15 years ago when you originally bought the policy. So that's kind of a big advantage here for reinstating an existing or an original policy. Now, if the policy is only 1 or 2 years old after it lapsed, you might maybe you should look at buying a new one because you're going to have to provide medical evidence anyhow. And so you might do the math to say, well, if I buy a new one, I'm only a few years older, and so instead of having to pay the back premiums plus all of the interest, etc., I'm just going to buy a new one. So you have to make that decision at that time. But usually in a situation where the policy is, at least 4, 5, 6, a few years older, it probably is advantageous to reinstate the existing policy since you're going to keep your original issue age of premium. Now, reinstatement is available if your policy lapsed. In other words, lapsed for non-payment of premium. If you, in fact, surrendered your policy, then you cannot reinstate it because you actually decided, you notified the insurance company and told them you no longer want this policy. So reinstatement applies primarily through lapsing of the policy, doesn't apply on surrender of the policy. So an important difference. Okay, let's look at this next point, which is a right of rescission. RESCISSION means to rescind, comes from the verb to rescind the policy. So the right of rescission is basically what we call the 10-day free look. So you have an insurance policy, you applied for it, you submitted your premium, it's been issued, and you decide you have 10 days, in fact, to change your mind. So if you decide, oh, I no longer want this policy within the first 10 days of accepting it, then you can get a hold of the insurance company and or your agent and say you've changed your mind, you do not want the policy any longer, and you can return it and they will give you a full refund of your policy. So you will be canceling the policy and in that period, and you're going to get a full refund. So this is your right of rescission. It's a 10-day right of rescission. Other, important clauses, expiry date. Now, this is going to obviously apply primarily if you have a term insurance policy and your coverage, in fact, is renewing. The end of the term, your policy is expired. If it was a renewable and convertible term plan, then on that expiry date, you can renew your coverage, so start on another period. If you didn't have that renewability feature, then obviously your coverage is going to expire. So anytime you have a policy where they're printing an expiry date, obviously that's indicating that your coverage expires unless you have some feature in the plan that allows you to continue that or to renew it. So expiry date is a sort of a common clause that is in primarily term insurance plans. Surrender charges, there are some clauses covering surrender charges. So you may recall that we had a discussion that insurance companies really don't make any money till, certainly on permanent insurance plans, until probably year 7 or 8, sort of a break-even point. And as a result of that, many of them will have surrender charges in the early years. They may be against the cash value usually if you surrender your policy early. And so those insurance policies, primarily permanent policies, will have a surrender charge in the early years. So if you surrender it, you may see an explicit charge, which would be in, for example, universal life type policies. They will tell you exactly what the surrender charges are. If you are in a whole life policy, you may not see an explicit surrender charge, but because they print your cash values in the policy, they already deduct that surrender before they print it in your policy. So you won't see it explicitly, but in fact it is there. And so in early years, we could experience surrender charges on our permanent insurance plans. So these are some of the key clauses that you should be familiar with in insurance policies.